Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm very excited to welcome Clem Chambers to the program. A financial journalist, founder of ADFN, Europe's leading stocks and markets website, and the author of books such as 101 Ways to Pick Stock Market Winners, A Beginner's Guide to Value Investing, and many more. Last time we had Clem on the show, he was calling for a major market meltdown in the face of Trump's tariff policy. Now that more tariff announcements are being made, how will the market and economy react? We're going to get Clem's take on the gold and silver markets and where he sees both metals headed in the face of heightened uncertainty on the geopolitical stage. We're also going to break down the biggest risks he sees facing markets on the horizon and how he is positioned to weather the storm. All of this and so much more ahead in my conversation with Clem Chambers. Clem Chambers, great to have you back on Commodity Culture. Last time I had you on the show, we discussed the tariff situation. You said you thought that once tariffs were fully implemented, this was going to be around July, I believe the beginning of July, that we could see a major meltdown in the broad market. Now, there have been a lot of delays, deadline extensions since then, a lot of flip-flopping on the tariff threats, but we have recently seen a new barrage of tariff threats out of Trump directed at Brazil, India, Canada, all of the BRICS nations in general, and more. What do you make of this fiasco at present, and do you still expect a serious correction in the broad market, given how well it's held up so far?
Well, I don't think it held up well. I think it crashed, and then I think they came out and pumped it back up again. So, it did crash, and it could have been a massive meltdown. But these days, regulators of one sort or another, the government departments of one sort or of another, come in and do a stick save, and they did a very successful one. The market has never recovered in the history of stock markets that I'm aware of, anyway, as well, or as fast and as steeply as it did when Mr. Trump came out and said, "Oh, now's a good time to buy." And then within minutes, up it went. Now, it could be prestidigitation, or it could be somebody pulling the print lever, the liquidity lever. Because what these central banks or whoever is doing it's probably not the Fed in this case, is they push money on the banks one way or the other, but basically by making terms sufficiently tasty that the banks can't go, "No, thank you." They go, "Oh, really? Oh, okay then. Oh, put it there, make money, and put it in the reverse repo and get you to pay me for the money you lent me at 1%, get you to pay me at 3%, or whatever." But basically push money into the system so people go, "What am I going to do with this cash? Oh, I'll put it in the stock market," and up it goes. So, that has been something that's been going on for a long time now. And I think that's exactly what you saw. But now we're back to where it was before the tariff crash occurred. So I'm expecting that liquidity to dry up somewhat. But, things are so, I want to say unpredictable, but they're not unpredictable. It's predictable that they're unpredictable. So really the question now is, well, first of all, will these tariffs cause some kind of global economic recession or a realignment or American recession or American inflation or American deflation? Because depending on what happens when something like this occurs, can be deflationary, can be inflationary. It depends on what goes on in money printing land. And if they go, "Oh no, oh yeah, the not rich people are suffering because they're paying the equivalent of an extra 2% income tax, we better print some money and hand it out to them." Well, that's what they do in South America. And that's why you get inflation rates like you get in South America. Now, if they were to say, "Oh, well, these tariffs equate to 1 to 2% flat rate sales tax or flat rate income tax. But tough luck, people, get busy, get tough. We're going to chin this out. We're going to suffer it and we're going to wait until things are better." Well, if they do that, then you're in a deflationary situation. So really, it all comes down to what the government does with money supply, M2 or whatever you want to call it, whatever you count as money supply. And it's hard to predict. I would say that we are in for a long-term elevated inflationary situation. I think that is what we will be seeing. So in that case, it's inflation you're thinking about, and you're thinking about protecting your confetti by spending it on some hard assets like gold and silver, or equities even. It's a long and twisted set of calculations you end up having to make.
Well, I want to get to the gold market a little bit later, but first I want to talk about just the escalations happening around the world in regards to global conflicts and geopolitics. Obviously, we have Russia-Ukraine, which continues to escalate. We have Israel-Palestine. We had a border war, or at least not a full-on war, but a conflict between Cambodia and Thailand that erupted. When it comes to the geopolitical landscape, how do you separate signal from the noise when it comes to evaluating what really matters as an investor? And what are the biggest risks you see on the horizon in the realm of geopolitics?
Mathematically, the way you remove signal from noise is you run moving averages. So you look at Ukraine and Russia and say, is that getting worse or is it getting better? Or is it staying the same? And then you say, well, Israel, Gaza, Israel, Iran, America, Iran, Pakistan, India, China, and you could just average it all out. Is it kind of getting worse or is it kind of getting better? And we've had such a bad run, you would expect the moving average of conflict is getting higher and higher. But, where's it going to kick off next? And the big question is obviously America versus China, because that's the big one. I mean, that dwarfs everything else. And, do we know where it is? The thing that I think of, I wrote a piece very recently about this, is what is Trump going to do next? Is he now going to spend the next, 3.5 years or 3 years, being, calm and not picking a fight with random people? Or is he going to invade Greenland? Or is he going to, send tanks across the Canadian border, or do something unkind to the Mexicans, or randomly, get angry at somebody? He's randomly getting angry at India right now. Actually, that could be good news, because, if America was squaring up to a conflict with China, it needs to consolidate India. And you can't expect India to be on your side if you're giving them a hard time. So, and you can't expect America to pick a fight with China if India is not on America's side, because the last thing in the world in that conflict you'd want would be China and India versus America. That is not a good configuration. So actually, if America was cozying up to India, then you should be more worried. But, it really gets really complicated, because there's so many moving parts. And one thing that most people, anybody that knows anything about game theory, will think about the minimaxing conflict. But when you have more than two parties, conflict is unsolvable mathematically. So then you're into the land of random outcomes. And, I think that's where we are. But we do know that the players are increasingly random. So the range of outcomes is wider. And therefore the volatility will be larger, and people will go to assets that are stabilizers, like the precious metals, like blue chip stocks, for example. So in my mind, we're in a bullish trend. We should be, with the possibility of these Mars attacks that we've been suffering all year. So, precious metals is good for that. Defense stocks, well, European ones at least, are good for that. So that's where I'm positioned. But, there's a lot of volatility out there. My portfolio was swinging around like a lunatic in the last couple of weeks for no apparent reason apart from the dollar. And the dollar is a total wild card, absolute total wild card. You've got, it was funny because the jobs numbers came out that said, employment in America, not so good. Trump gets angry, sacks the lady that puts the numbers together, and then shouts at Powell for not dropping interest rates. And the very number that would make him drop interest rates is bad jobs numbers. So He's punishing the woman that's given him the ammunition to get power to drop interest rates. Work that one out. Yeah. So this is the background situation of these things. First of all, the markets are almost absolutely geared towards Donald Trump, which is, a pretty difficult place for any investor to be, because you're then just trying to ascertain what the next thing is going to come out from the White House. And as we know, it's hard to predict. I mean, anybody that can talk about, taking over Greenland, you can say pretty much anything. And then does he follow through? Well, sometimes not. So that level of randomness. So the noisiest player in the market is the person that is calling the tune. So that makes it very difficult. But if you kind of stand back far enough, you can see a volatile, elevated inflationary market with people that can pull levers and pump infinite money into the system at all kinds of random economic levels, most of which will juice up the stock market.
And now a quick break to hear from our sponsor, ARK Silver Gold. Osmium owner Ian Everard is considered one of the most honest and level-headed gold and silver dealers in the United States, praised even by his competitors. So give him a call today to take advantage of the specials right now. Silver Kangaroos 2023 1-ounce coins, mint fresh, only $2.47 over spot. Mint fresh silver maple leafs 2025 coins, 1 ounce, $2.87 over spot. While supplies last. Reach out today at 307-264-9441 or by email at ian@arksgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Well, let's talk about the gold and silver markets and how you see them positioned at present. We spoke about both last time. You were very bullish. And from what you're saying now, I see you continue to be. Give us your outlook on both the precious metals and maybe a little bit of insight into your own portfolio. You mentioned gold, you mentioned European defense stocks. If you could expand on that a little bit and let us know how you're positioned in the face of all this uncertainty.
I would say when it comes to precious metals, you said both. Well, there's not both. There's four. There's gold, there's silver, there's platinum, and there's palladium. Now, platinum and palladium are, for me, where my heart lies, because 10 years ago, say, platinum was 1-to-1 with gold, and palladium was 1-to-1 with gold. And if you went back another few years, 2-to-1 with gold. Yeah. So platinum should be $7,000 an ounce now, not $1,400. If the good old days came back, and you could say, oh well, it's not the good old days. Things change, technology moves, blah blah blah. There's 3,200 tons of gold made every year, 200 tons of platinum. 3,200 tons of gold, 200 tons of palladium. And palladium was totally out of fashion, probably still is in a lot of people's minds, because they get put in cat converters in cars, and the internal combustion engine is going away. Was going away. Isn't going away now. And platinum and palladium are useful for all sorts of environmental remediation from the creation of energy, i.e. pollution. They are catalysts that are very, very powerful catalysts to break up pollution and make pollution less worse, if you can put it that way. So with that in mind, you're only making 200 tons, and a larger chunk of that is coming out of Russia. And today, the Indian government was complaining and saying, hey, you want to punish us for buying oil off of Russia? You're buying palladium off Russia. So, what are you talking about? You're being a bunch of hypocrites. Why are you buying palladium? Well, because America has to buy palladium off Russia or else. And there's only 200 tons of it. And it's only made a little bit in America, a little bit in South Africa, and a little bit in Russia. And it's $1,100 an ounce. And it used to be the same price of gold, which is $3,200. Now, if you flip that around a little bit, and I will flip it around a little bit, silver, apparently, there's 25,000 tons of silver mined every year. So that's about 1/8 of what gold is mined at. Well, as we know, silver is a 100th of the price, even though they only mine, 14%, 8 times as much. So that's an interesting number. So you've got gold running ahead because gold is for war. So this global tension is affecting gold, but it's only a matter of time when it will start to filter through into silver and filter through, into platinum, palladium. I just see that as one of those no-brainers that can often get you in trouble. So I am positioned heavily into platinum and palladium. I've got a fairly large chunk of gold, and I've got, a few hundredweight of silver. But silver is the retail version of gold. So that's why I have silver, because I see that as, when retail wants to buy precious metals, it will tend to veer towards silver because, it's a lower, you get more for your money, and people like having a sack of silver for $1,000 rather than a little disc of gold. And there is a certain pleasure in a sack of silver. I once had an idea of buying like $1,000 worth of silver coins every time I went to America. And I was going to America 5 or 6 times a year. And then I realized I would have a pile of bags of silver in my basement and I'd look like Scrooge McDuck. So I kind of went off the idea. But, you can't beat a sack of silver really, kind of emotionally. Apart from a sack of gold is even better, of course. But outside of that, silver is the retail gold. And platinum, palladium are these incredibly vital, really, really out of fashion precious metals that the out of fashionness is turning. I think I mentioned maybe on your show a few months ago, but when I started talking about it, they're $800 and $900 an ounce. Now they're $1,200 and $1,400 an ounce. So they've already performed well. But when you think 1 to 1, that would be 3,200, and gold could easily go to 5, and. It's one of those ones where you go, what have I got wrong here? And you find out you just have to wait 2 years for everyone to catch up.
Yeah, patience is key. That's a great point. Energy has been a big theme recently with the projected demand from AI data centers, along with a new middle class emerging in developing economies. A lot of analysts predicting a significant rise in energy demand globally. Would you agree with that prediction? And if so, do any of those areas of the market, oil producers, uranium miners, other commodities involved in energy generation, does any of that look attractive to you right now?
I would say I disagree with that, but not for the reason you think. Energy demand is not going up. It's going to absolutely explode. It's not just going, ooh, ooh. It's going, because AI it's not percentages we're dealing with here in energy consumption. It's X factors. It's multipliers. There's going to be, the number's almost inconceivably higher because let me share a thought with you. Okay. There's no second place in AI. If you're America and China's got more AI than you, you're sunk. Yeah. If America's got more AI than you and you're China, you're sunk. If you're India and America and China, and for that matter, Europe has got more AI than you are really sunk. Yeah. There's no second place. Yeah. Now, okay, no second place. Oh, let's buy Nvidia shares, blah, blah, blah. This stuff uses pure energy. It doesn't mess about. It's pure energy. It's like having a space heater, this hardware. Yeah. AI equals energy consumption, full stop. Oh, they're going to make it more efficient. There's still no second place. There's infinite, uncapped demand for intelligence. The only possible limit could be they can't make any more intelligence. We've got maximum intelligence now. We can't make any more. We just don't know how. That's the only thing that would stop infinite demand. And then, I was talking to some government person a few months ago, and he said, well, once you've got AI in your aeroplanes, we're done, aren't we? And I said, well, no. What about AI in your missiles? What about AI in your bullets? Why wouldn't you have AI in your bullets and in your rifles and in your pistols? And in the 4 bullets that it fires out every millisecond? Why isn't there 6 pieces of AI in that robot? Etc. There's just no limit to the amount of AI that will be not needed, but wanted. So therefore, there's no limit to the amount of energy that is required. In fact, the only limiting function is energy. Well, they're going to boil the oceans because there's no second place. It's a war, really. It's an AI war. Tell me what limits the amount of AI demand? Nothing. There is no limit apart from the ability to power it. Well, what X factor is that for energy? Why do you think they want to build nuclear power plants all of a sudden, having for the last 30 years said it's the worst thing since the devil incarnate? Oh, nuclear energy is nice now. Oh, yes, don't worry about your children getting leukemia. No. Yes, nuclear power is the future. Why do you think that is? Why do you think the internal combustion engine's not going away anymore? Why do you think they're saying, coal, yes, we said it wasn't great. Yeah, we said it was bad and we're all going to die and the polar bears are going to drown. We said, don't worry about that. We're going to dig up coal now. Yes, coal, we like coal. Coal is good. We like coal. It's good. That's why. Because there's no second place in AI. And once you've had all your windmills going around, and once you've had all your solar panels doing the solar panels, and once you've built all your tidal barriers, and once you've plumbed all your geothermal, well, then you're going to be burning oil, aren't you? And then you're going to be burning, gas first, and then you're going to be burning oil, and then you're going to be burning coal, and then you're going to be burning peat, and then you're going to be burning nuclear energy. And then you're going to say, can we have some more, please? Where do we get more? We need more. We need more. More. Let's build some more nuclear power stations. You're using all the uranium. Why don't we do it with thorium now? There's no end to it. There's absolutely no end to it. The important thing is this will drive massive economic expansion because you'll have all this energy and it won't necessarily all be running at the same time. And it will mean that there'll be this massive pipe of energy availability. And that will also drive everything else. And they'll be trying to drive the price down because the more you can drive the price down, the more AI you can have. There's just no end to that. So think about, energy is going to go up now. Oil companies might be quite good. It's like, it's going to go off the dial and it's going to go off the dial really quickly. Because remember ChatGPT, when all the politicians penny dropped, that's 18 months ago? How long did it take them to start saying, nuclear power? Yes, please. How long did it take them to say, coal, not so bad after all. Yes, we love coal now. How long was that? How long was it they say, banning internal combustion engines? No, not going away by 2035 anymore. Let's call it 2050 because I'll be dead by the time they have to move that date back. Yeah, didn't take them long, did it? Because, when it's about the government, if it's about you, maybe they're not so keen, but when it's about them, they get really busy, like with crypto, yeah? Internet came along, they went, so what? Yeah, we don't care. 10 years before they woke up to that, maybe more. As soon as crypto came out, they went, no, we don't want any of this money, that's ours. We do that. That's, you don't do that. We do that. Stop that. It's naughty. Right? And when AI came out, they quickly caught on and they went, if those other people are smarter than me, I'm toast. We can't let that happen. Hey, let's build service and plants everywhere we can. You've seen that explosion because it didn't take them long to work out there's no second place in AI. And once you get that idea, there's no second place. The consequences of that are absolutely dramatic. And energy is at the very, very core of that.
Great thoughts. I also want to pick your brain a little bit on non-US equities because a huge percentage of global equity investment is in the United States. And, it feels like we could be entering a stage of the market cycle where the emerging markets could start to perform well again versus the US. Are you seeing any signs of that? And is there any areas outside of US and even in Europe as well, not an emerging economy, but an area of the market that North American investors never think of. Outside of the US, are you seeing any opportunity at present? And if so, where?
Okay, so there's this thing with the US stock market. Okay, and I've always had this idea, which some people will like and some people will say he's mad, but always invest alongside the people in your government. What are their assets? They're not all Ms. Pelosi. But they've all got assets, and they will probably try really hard not to blow up their own assets. And what are those assets in America? It's equities and real estate. Funnily enough, they're two markets that keep going up and up and up and up. Yeah. So, people in government, as you would expect, look after themselves first. Yeah. And they look after their own assets first. And that's real estate and that's equities. So there's a kind of copper bottom, and nobody does equities like America. Absolutely nobody. I mean, the valuations in the US are incredible, and I'm not saying that's good, but they are incredible. And I think there's lots of legs. We're still late stage boom, and we're probably going to go into a bubble. So there's plenty of upside there. Now there's this dark cloud hanging over everything, and it's called the dollar. And the dollar is incredibly high, way, way too high. Now, a lot of people on a show like yours will say, oh, the dollar's doomed, the dollar's rubbish, oh, rubbish, dollar debt, oh, misery. The dollar's really strong. And the dollar was going away in the 70s, it was going away in the 80s, it was going away in the 90s, it was going away in the tweenies, and it's going away yesterday, and it's still not gone. And it's still not going anywhere, and it's still way, way overpriced. It's 20 or 30% overvalued in my book. And you can see that if you look at it's funny because people say, oh, look at America. The dollar GDP per head of America is so high. Look at the Japanese, it's half. Look at the Europeans, it's 2/3. Aren't we great? Well, no, your dollar denominated GDPs, the dollar's too high. If your dollar came down and everybody's yen went up and everybody's euro went up, it wouldn't look so good, would it? And when you think that the yen was 1-to-1 only a few months ago, 2 years ago, and it's now 150. It's actually, in dollar terms, lost a lot. But if you put it back to 1-to-1 again, you would see that there would be what looked like parity. And if you go to Europe and you look around, Germany or France or Holland or Britain, it doesn't look much different from Cincinnati or somewhere else. You can see that the wealth, there's a parity there, but not GDP per head. And that's an indication that the dollar is so blooming strong. And you can see it in the long-term chart. If you see the long-term chart, it was trading down here, and now it's trading up here. Yeah. And that's because of the Fed and the dollar being the reserve currency and all that good stuff. But it's too blooming high. And the interest rates are too blooming high too. And they're coming down. Well, they're not too high because the Fed is wanting to squeeze inflation out, and it fears that there's more coming down the pipe because of tariffs, and their data says the inflation's not over yet. And whereas maybe the politicians would say, we don't care. We don't mind 4% inflation. We'll blame it on someone else. Right. And the Fed says, well, it's our job to get it down to 2. That's our job. We do that. And we do that with high interest rates. And you guys keep running these massive deficits and sloshing all this money about, and it makes it difficult. And the politicians say, we don't care. We want to get elected. We know how to fix inflation, but we don't know how to get elected after we've done it. Yeah. So, that is the dynamic. But interest rates are coming down. And when they come down, the dollar's going to come down. Well, if you're denominating dollars and you've got all your fancy stocks in dollars and you're thinking, the value of my shares is going to go down globally. If I could get out of my telco in the US and get it into a telco in Germany or in the UK, when the dollar comes down, I'm going to have more dollars in telcos. I can flip out and flip back into Verizon or whatever. So there's a pull out of the US market by people that want to flip into non-dollar denominated stocks. And that is going on. And that has been something that's been happening up until a bit of a rebase a couple of weeks ago. And now it will start again, now that the jobs numbers came in. So there will be we need to think about heading for the exit in the dollar, or at least lowering our dollar exposure, increasing our foreign currency exposure. So in big stocks in countries denominated in euros and yen and pounds and other stable-ish currencies will take a bit of an updraft. And of course, you can buy them as ADRs in the US.
Right. Yeah, great breakdown. I want to also discuss cash position because Berkshire Hathaway now has around 30% of its assets allocated to cash. A lot of people, now, does that mean anything? You can infer from it what you will, but a lot of market commentators are pointing to that and saying, see, Warren Buffett, he's super smart. He's mostly, not mostly, but a huge percentage of Berkshire Hathaway in cash at present. That means he's anticipating some big potential market decline, and he wants to have dry powder on the side to be able to take advantage of bargains as they present themselves in that environment. Do you see things in that way? And what about the importance of holding cash as an investor these days? Is that something you think about?
That's a different question.
Yeah. So both. Let's throw two questions in one.
I think it shows a lack of empathy to think it's Warren Buffett trying to be clever. Warren Buffett is doing estate planning. He's had his best friend, a lifetime co-buddy of Berkshire Hathaway, pass away only a few months ago. And you see him, he's very frail now. He's 92 years old. I mean, he's not the guy in The Old Godfather, the old man thinks he's going to live forever. No. What he's doing is he's getting Berkshire Hathaway shipshape for what's going to coming up next. I mean, you would have to be negligent in his situation to be sat there in all these positions when you're that old. I mean, life expectancy in your 90s is like 6 months. Yeah. So if he's, I mean, obviously, long may the king live, but his life expectancy is about 6 to 9 months. Well, you can't be all in, can you? When the clock is ticking down like that. And he is clearly a lot less robust than he was a couple of 3 years ago, and of course he knows that. He's one of the smartest guys on the planet. Wouldn't you think, when your partner just passed on, who's been a very important part of the equation, and you are 90 billion, that you wouldn't be going to cash? Because what's going to happen to Berkshire's share price when he passes away? I mean, it's going to go down quite a lot, isn't it? So best that it's mainly in cash. That's how I read that. And would he not be negligent not to be going slowly but surely to cash at his age? And I think it's simply that. And why wouldn't it be? I mean, what would be an alternate situation? I'm 92. There's another market cycle coming up, and I'm going to show you how it's done again. That's way less likely than him just doing his housekeeping.
That's actually a great way of looking at it that I haven't heard before, but it makes a ton of sense. Now, what about for individuals right now with the current valuations in market? We've seen the Shiller PE ratio hit an all-time high. That's another indicator a lot of people are pointing to. Is this a time to have at least some portion of your investable capital sitting on the sidelines in anticipation of a potential market correction? Do you think it's more prudent to follow the whole time in the market versus timing the market, just keep dollar cost averaging, which some people do? How do you approach the market when it comes to having a cash position?
I look at my old portfolios and I cry, because I've managed to get out of every single big dip since 2004. And when I look at ones that I got out of and I just left for 5 years, they have outperformed. And I mean, look, I saw this crash coming, and I got out before it did anything. I got out, and down it came, and I felt so clever. And it hit the bottom, and then it turned around. I thought, wow, that's incredible. That's incredible. And I re-entered some of the way back, and I've done exceptionally well on that section on the way back. But if I'd held that previous portfolio, I would have made twice as much money. A big arse amount of money. A boat. Another boat. Yeah, worth. So I was smart enough to get out, and I wasn't, genius. And I still wouldn't. If I look back at it and I go, I regret. No, I don't. I don't regret that. I'm looking at it going, what the devil went on there? It was retail buying the dip. Yeah, not. Yeah. So, in many ways, inertia is a very strong thing, and it's hard to beat that. Now, three of the crashes that I dodged worked out brilliantly for me, absolutely brilliantly for me. But even those portfolios, I can look at and go, they did quite well, didn't they? Buy the dip and all that. Well, if I hadn't sold, I wouldn't be able to buy the dip. But nonetheless, over time, it all flushed out. So timing the market, which is I always do it anyway. So I'm saying something that I don't do, which is not timing the market, buy and hold has a pretty blooming good record. So nobody should be ashamed of buy and holding, or buying and holding until their target is reached and then rotating into something else, or whatever their ongoing process is. Trying to go, oh, it's getting a bit expensive. Oh, I'm starting to worry now. That is not a way to think. If you look at a stock and you go, I've got the profit the reason I got in at 60 was to sell at 100, and now it's 103 or 97. I'm out. I'm going to sit my cash there and wait for some other fish to swim by. That makes perfect sense. But to go, oh, it's too expensive now. Oh, my crystal balls are telling me what to do. Oh, I'm going to get out. That normally doesn't work out well at all. So, you should be. The only other time is like if you're waking up at 3 a.m. in the morning and logging into your iPhone to see what the yen did, then you've not got a right balance in your portfolio. So for sure, you should always hold positions where you can sleep at night. Yeah, because it's not good for your health to be committed in a way that makes you constantly anxious. I mean, who needs high blood pressure? Who needs to be the richest person in the graveyard? So, you should always hold a portfolio where you're comfortable with it. So if you're uncomfortable, you need to look at it and then work on that portfolio until you're comfortable with it. I mean, what I do if I ever get like that is I go like with this crash that came up. The first thing I did was I looked over it and got rid of anything that I couldn't remember why I bought it. It's not much of that, but occasionally you get that. And then, I thought, oh, this hasn't happened yet, but it's coming. So I look at the next weakest links and get rid of them. So you go through your portfolio one at a time or chunk at a time, and then lighten your risk. And then when you suddenly, sometimes you go, I'm enjoying selling this. I'm feeling relieved. And you get rid of more. But ultimately, what you feel is not a good indication of what's going to happen. But if you just tidy up what you've got, and you go, yeah, that was good. Oh, I've done really well out of that. Is it going to do? I'll take that off the table. So you just take off the table until you feel comfortable. And then you can put it back in again, in something else. There's always another bus coming. So, that's something to think about. So really, the way that I see it is if you trade, you're treating the market like a casino. And what do you know? It'll treat you like a punter. Yeah. If you treat your portfolio like a farm, it will give you a crop. So, be a farmer, just go over it, cut some trees down, pull up a few turnips, and you'll be fine.
Well, Clem, this has been a fantastic conversation. For those who want to learn more about you, where is the best place to go online? I know you've got a new fn.com website at the moment. Tell us about that and anywhere else you want to direct people as well.
Yeah, that's coming up. We're aiming for St. Ledger Day, which is a very obscure English concept. That's when the market is meant to come back from holiday. So that's mid-September. So we're aiming at coming out with that offering there. And if anybody wants to put their name down on the wait list, then they'll be the first to get in there. And there'll be a restricted opening because, if we open it too fast, it'll break immediately. So we will be opening it to a few thousand people to begin with. And then I've actually decided I'm going to do a bit more. I'm not a fan of Twitter. It makes me mentally ill. Like it makes a lot of people mentally ill, but I've decided to post a bit more there. So if they want to go and follow me at Clem Chambers, I will be posting bits and pieces and links to more of my other stuff like this thing. I'll post this on that so people know that I've done something. And the way that I see these things is I know a lot of people come on and say, oh, I know the future. I predicted this and I predicted that and I'm right. I'm not like that. I don't see what I do like that. I see what I say and what I'm talking about as raw material for the listeners to think about. And they might go, he's completely mad. Or I haven't heard that before. Or that's wrong. But raw material to chew on, to fine tune their own methods. And this is why I do this actually, because it forces me to crystallize my thinking so that I can talk to you and talk to your viewers. It forces me to go through all the ifs and buts and make it all cogent and internally consistent. And I find that helps me juice my profits quite significantly.
Well, you've outlined basically the reason I make this show is to have people like yourself give a variety of different opinions and outlooks on the market, geopolitics, and all these different topics that are important, and then to have the viewer be able to pick and choose for themselves what's actionable, what makes sense to them. So thank you so much for coming on again. I'm going to put links in the description below to both anewfn.com as well as your X profile, Twitter, whatever people want to call it. And people can also follow you there. Thank you so much, Clem. It's been a blast.
Thank you very much, Jesse. It's great to be on again. See you soon.
Thank you for being with us today. Take advantage of sponsor ARC Silver Gold Osmium's specials right now. Silver Kangaroos, 2023 1-ounce coins, only $2.47 over spot. Silver Maple Leafs, 2025 1-ounce coins, just $2.87 over spot. Well supplies last. Reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com. And make sure to tell him that Commodity Culture sent you. And be sure to pick up your Commodity Culture merch. Link is in the description below. Everything backed by a 100% quality guarantee. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.